Seth Freudberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So I'd like to talk today about backtesting. Options traders love to backtest. Market neutral, positive theta options traders like to backtest to see how a particular structure or a set of adjustments to a particular structure will work out over the long term. It's a very, very good idea. A lot of times you'll design a strategy around what happened last month, and what you don't realize is last month is one month out of the last 60 months over a 5-year period, and a lot of different things can happen over 5 years, and a strategy which would have worked great last year or last month might very well have been horrible in many other months. So backtesting's very important. Every good trader I know has backtested extensively because it helps you to hone the strategy, figure out its weaknesses, come up with solutions, and try it again. So we've been working, we have this strategy that we have developed called the Heart-Friendly Butterfly. Some of us trade it, a number of you have the video series, and we are working to improve it now. It was designed some time ago, and we took another look at it to see are there ways to make this even more powerful. And the base strategy actually is pretty good, gives you a pretty good return, but we were wondering if there were techniques that could be used to improve it a bit. And so we're working actually with a very fine firm that does back testing of different parameters at incredibly high speeds, and so it's been very helpful. And basically they go through, this firm goes through your strategy, codes it up, tests it back 10 years. It takes about 12 seconds to test 10 years or some very short period of time. And then it comes up with how the different components of the trade could be modified for a more optimal result. And so one of the suggestions the firm came up with was to allow the max loss on the trade, which was 10%, to allow it to go to 50%. And if you did allow it to go to 50%, in other words, you gave the trade room to draw down until it came back, it would indeed improve the return. But there's a problem. And that's really the essence of today's video, because there's a difference between backtesting a theory with no money up on the table, monopoly money, versus actually trading your real money live. And that there is a very large difference between those two processes. So the problem with going to a 50% max loss is that I don't know anyone who trades like that. I don't know anyone willing to lose 50% of the capital that they have invested in a trade in 1 month. I've never met that person. I don't expect to meet that person. So you could theoretically have a better return over a 10-year period with a 50% return, with a 50% max loss, but no one's ever going to get there because no one's going to allow such a drawdown. It's really not realistic according to normal human behavior. And another issue is, can you, suppose you were somehow psychologically strong enough to handle a 50% drawdown, do you have the resources to replenish that capital in those months where it draws down? Because it's really going to draw down, and those funds are really going to come out of your account. What do you do then? You've got to have a funding plan. Most people don't have a funding plan to replace 50% of their account. So, and don't tell me you're going to sell your house, because you're not going to sell your house. Someone's going to get mad at you for trading, and you'll go out and get a job. So it's not real to have a 50% drawdown on a strategy, and therefore we decided not to focus on that particular suggested modification because no one would trade that way. So what's a good way to think about how to backtest? Here was an example of a very logical process which arrived at a conclusion that was totally unrealistic. So how do you arrive at those conclusions that are realistic? How do you sort out from some process like this which suggestions are actually feasible and which ones are not. And so I think you need to ask yourself a bunch of questions. The first one is, how much are you honestly willing to lose? That's probably the most important question. And if the answer is not 50%, then don't test a trade which necessitates a 50% drawdown to have a good return. Just, don't bother. You're wasting your time. If you, whatever drawdown you're willing to accept, have you set aside the resources to replenish your account? Now, this is an important one, because if you don't set aside those resources, then your backtest is worthless, because if you are going to allow your account to shrink as you continue to trade the strategy, your returns calculation gets thrown off because the denominator is getting smaller. You may get the same return, but you will make less money. So you've got to have a replenishment plan for your funds for whatever max loss you choose. Another question you have to ask yourself is, what time zone are you in? If you're in Indonesia and Australia, like a couple of our traders, you've got to trade differently because you're not going to be awake during certain parts of the market. So if you have a backtest which assumes that you will adjust whenever the market hits a certain price point, and you're asleep during that price point, that's not a very useful backtest, is it? Because you're not going to be able to react to that situation. So what time zone are you in is a real question you need to ask yourself. Another question you need to ask yourself is, what is my career situation? Am I in a job? Will I be able to get to my desk at all times and man the market at all times? If the answer is no, then you can't have a backtest which necessitates you being at the screen from 9:30 p.m. Eastern Time to 4 p.m. Eastern Time when the market is open on the East Coast. So what's the moral of this story? The moral of this story is, don't waste your time backtesting a strategy you're not really going to trade. And for a brand new trader, this concept may be a little harder to get a handle on because you don't know how you react to the market. Only by trading do you start to get a sense of how your personality and trading interact with each other. But I will say that once you get some feel for that, you are in a much better position to determine whether a strategy will be realistic for you as a trader. In summary, you have to design your backtest to be consistent with your situation. Otherwise, you're wasting your time. So think about that next time you design a backtest, and we'll see you next week. One of the most powerful strategies that we sell here at SMB is the Rock Options Trading Strategy developed by John Locke. It's on sale this month, and we've also put on sale packages including the Rock Options Strategy series. So please take a look. It's a very good opportunity to get this program at an excellent price. And the way you do this is you go to optionstribe.com, click on the links menu, and then you will see at the top the Rock Option System. Click on that, and you will be able to find all the information about your buying this program. Thanks very much.